History is repeating itself. The whipsawing of the market rallies and then going into quick pullbacks is all under the spell of these high inflationary periods, which is very similar to the 1940s and the 1970s. And right now, we're seeing overextended companies getting hit hard as, under the surface, the rest of the market, we're seeing other sectors quickly climb the ranks. This clear rotation, we go to Gary Glover to highlight the sectors to watch and the companies that he's looking to trade in this environment is something that he's researched in great detail. Good morning, Gary. How are you?
I'm good, Chris. Yourself?
Well, I'm happy to read your report and see that you're sort of reciting back on the research that you looked at in the 1940s and 1970s and what we expect in the inflation movements. And at the same time, you're looking under the hood of the market in the different sectors to find sort of where the strength is, despite the obvious leaders that then suddenly get hit. So I'm pretty excited to see what you've got in store for us today. When you're looking at the portfolio, is there anything that's standing out to you, or you look at the indices and go, hey, look, there's something quite significant going on here?
Yeah, look, I just had a few things. Obviously, some of those major indices there, like the Nasdaq and the S&P, sort of hitting some key technical sort of targets there. So there definitely some levels where they can kind of retrace back here. Typically, don't see big pullbacks in election years. So, maybe something like 4 to 8 is probably about as big as it gets typically from a percentage point of view. So should sort of see rotation in these type of markets there. And 40s and 70s as well, the inflationary markets there. Definitely saw rotation in those markets there. Quite volatile there short term, but probably don't go too far long term. Sort of what those markets did. I think they sort of did the slow climb as well. But just definitely also volatility. So we should sort of see some rotation. So it was obviously interesting to see the small caps jump the other night when Nasdaq was off quite a bit. And then in our market, we saw, property trusts, we saw building stocks, just saw, some defensives as well.
Bio as well.
Yeah, so we've seen the healthcare names and biotech as well have a bit of a bounce as well recently, probably the last maybe 3 to 4 weeks as well. So definitely seeing some rotation within our market as well. So that's a good sign there. So with the banks, to me, the banks look a bit cooked here, Chris. They really, apart from being on super high valuations, probably started to see first signs of selling for those, and some timing for those as well. So if they sort of pull back, you'll need other parts of the market to sort of do some of that lifting, hold the index up. So we do need some other sectors to hold up here. So probably resources is the key there because they've all come back, the resources there, and banks are all extended here. And there's mixture within some of the other areas there, but we're probably going to need the resource sector to bounce here if the other banks are going to weaken for the market to hold up. If the resources don't bounce here, then banks pull back as well, and the whole market's going to pull back. So we don't really, that's not where the cycle suggests. So that we kind of want to see that rotation here as well. So just will be an interesting week here on our Aussie market as well, just to see whether those resource names can actually sort of hold up there. But seeing rotation through some of the other areas, but I think the resources is probably key for our index to sort of hold up here.
Well, obviously the Nasdaq that's on chart, there's not much exposure to the resource side of things, but definitely has been running up. And you've got the FIB levels that it's been pushing out towards that 138.2. Something you've highlighted before as being possible resistance point to come up and touch and then turn around.
Yeah.
So you've said we don't really expect too many pullbacks in an election year, 4 to 6%, that kind of thing. Would you expect it to sort of pull back into this sort of wedge pattern, or maybe just meander sideways and be a bit of a choppy fashion? Are there any cycles that are pointing one way or the other for what we can see for the next 4 to 6 weeks?
Yeah, not too much, nothing sort of too obvious there. I mean, it's pretty bizarre that we're actually following the 60-year cycle almost on cue. That's kind of really, I mean, I've seen it before. I think in the last sort of commodity boom there, we were, all the commodity cycles were hitting highs in the same months as they were 60 years earlier. So it's interesting here. I think the S&P 500, I found a high around the 17th and 20th of July there back in 64, and then pulled back into early August and then bounced again we had a little pullback into October again, but just, we're almost hit it on cue. So I don't know. It's just that sometimes I don't know why those cycles work. Obviously, it's GAN refers to the 60 years being the sort of master cycle, and then looking at all the other cycles around it. But it's sort of it's going against a lot of it's going probably varying quite a bit from a lot of the normal election year cycles. So it's still pretty robust there. Still only had small corrections, but the 60 years is the one that it's been following the closest there so far. So just a bit of area there that sort of found the high pretty much the same sort of date here, pulled back here. But that doesn't suggest any big correction, Chris, just sort of suggests a bit of a pullback. So, I don't see it pulling back beyond the last high. So that's probably the biggest correction I would see. But, maybe it's smaller as well. Maybe we just sort of can guess back here. Different markets are sort of looking quite different to me. So, but yeah, we might just sort of end up back in the range a little bit here. Might be a little choppy there.
Okay, so that's come up like a magnet, like you were saying before, the 161.8 Fibonacci level, and then hitting that, and then more possibly coming back to sit on the high of the S&P 500.
Yeah, but that S&P 500 is more dominant. That 161.8 is a lot more significant than the Nasdaq at 138.2, because if you go back and study the S&P 500, like a lot of major highs come in on the 161.8. So that's probably the big negative, is that like a lot of important highs do expand out to that level, just like it had. So yeah, the 61.8 is just a bit of, it's always a bit of a key level for the S&P 500. Just a lot of history there. I mean, we even saw on the way down that, we that lower high there, I think might have been August, September of 22 there. That was 61.8% of the range to the low as well. So that last leg down there was 61.8% of the range to the low, so that's just an index that just that range just keeps popping up there. So it's for the XJO, it's a 50% level. Like if you look at the 50% retracement, look at 50% expansions there. I know sort of following McLaren's work over the years, they used to do like 50% expansions on the daily ranges and stuff there. It would just be hitting that on cue, pulling back, hitting on cue. It's just one of those sort of levels. It's just each sort of stock or each sort of industry's got its own personality. So that's a really important level for the S&P 500 to be sort of finding some resistance overall. So that's why I think this one might just pull back, maybe still on top of the old high there, and then maybe build again there. Don't envisage any big corrections there, but that is definitely a significant level on the S&P 500. So I do think this will be not a tiny, or what won't be nothing here. I think it'll be something in terms of correction here. So I think we just might get a bit of a just a little cooling off here in the S&P 500 there. And you're seeing some of that, some of those sort of growth stocks come off a little bit there, some of the tech stuff there. So even in the state sales, I saw David Ryan talking about he was trading some of the property trusts. Recently, so look at the same thing. So, he's sort of saying some of these things are yielding 8%. He's already had a 10% bounce on the stock yielding 8%. So he's saying he's sort of seeing the same thing. So that's a good sign.
That's very comforting. That's exactly what you and I were going through last week and the week before, seeing light up the launch pad as being potential next leader, seeing one of the world's most respected and best traders looking at the same thing. So obviously different market. You're talking about resources before in the Aussie market, trying to be the counterweight to the overextended banks. So if the banks and financials are overextended in this high inflationary period with low growth expectations, very low yields, very stretched earnings, if they're coming down, which they have, sort of held a bit of resistance, you're saying that we would like to see the resources pick up the slack to help offset that possible fall from the overextended banks. But we're not seeing that right now with the resources, sort of copper prices down, South 32 and so on, having some decent falls. What else is happening in the market? And is it all contingent upon resources, or are there other things to look at under the hood as well?
Yeah, I mean, we've had a few other, obviously the healthcare names are sort of looking like they're improving there. So seeing, CSL and Copper have had a pretty good bounce there. Some of the other names as well. So like I know sort of even Helios and Sonic have had a bit of a bounce there. So definitely seeing some of the biotechs and healthcare, showing a bit of something here, sort of bouncing there. So that's quite good there. Definitely seeing property stocks and building stocks as well have a bit of a bounce as well. So there's definitely pockets there where there's some value. So they have been bouncing there. But in terms of our index there, just after we sort of broke out of that little, sort of tightening pattern there, thought we might get to 8,100 there, but we just fell short of that. Have pulled back here now. So more than likely probably come back and retest the break zone, which I think pretty much hit yesterday. And then that's where it can actually bounce from. So we do need, it's had a bit of a bounce there today there. I think if the banks are going to drift off here, which I think they will, then I think we'll need other areas of the market to get up. But as this, that resource component is the big one from a weighting perspective. So the beauty is that they're all on the knees at the moment. So they are sort of all down. They all have
coming from a low base to take turn.
Yeah, that's right. So, but so far we haven't seen them turn yet. That's the catch-22 at the moment. So they have sort of broken the new lows, a lot of them. So, but they will need to sort of show some support here, show some sort of signs of reversing here. So that's really pivotal for our market this week.
Nice. Well, that's what we'll be looking for in the week ahead. When we look down into those sectors and look for trading opportunities, looking into your report, we've got a few individual shares, but quickly just looking at the Dow Jones, can dance to a different drum compared to the NASDAQ and the S&P 500. What's happened here, and what do you take from the most recent movements?
Yeah, it's a funny sort of overshoot there. I mean, it is a bit of a, we talked about that being on a sideways sort of corrective trend. So it's not the strongest sort of trend there, but it did sort of fire up there last week, but then they all gave it all back. So unusual to see that go as far, but it is slightly unusual market overall. So we, give it some scope here, but that looks like we're sort of probably, definitely a bit of a rejection from that, rallying high there. So again, so I think you'll sort of see it cool off here, but I just don't see big corrections there. It could come back to the old high, which would be probably too deep for me. I think we might just strip back into the range here again. But yeah, just probably that sort of big outperformance there probably just shows that it's going to be a little messy here for a bit. So, but yeah, I just think, it's just more than likely probably just to retreat back into the range there. But I think we'll probably bounce from probably the range again. Just don't see big corrections this sort of year. Value shares typically do pretty well. Inflation's still pretty high as well. People are still looking for yield stuff there. So don't see a big sell-off there really in that area.
Well, we'll put a link to your research insights for the inflation period to the 40s and 70s if people want to look in more detail of the leading sectors and where the expectations are for better returns based on historical performance. Put the link down below in the notes. Coming to the trading shares now. So Australian Clinical Labs, definitely that downtrend, but the 1, 2, 3, and then the false break. So these are 3 consecutive lower lows.
Yeah.
And this one just undercuts it. So what do you read from it?
Yeah, so sort of got that broadening sort of bottom sort of formation there where you sort of get 3 mild new lows there. So that's often how a lot of, it's often how a lot of deep lows do come in actually with that sort of 3 thrust sort of low there. But what that is just, it's a corrective sort of trend there. So sort of shows that each new low is just going marginally lower. And you typically see the volume sort of dry out, which we did sort of see that coming into the lows and stuff there. So you should see a little bit of volume, at the lows and maybe on the rally start to come in. They should sort of start to build from there as well. So yeah, starting to see a few little signs there that, exhaustive, that we've had a bit of a bounce there, a little bit of volume come in. Pull back here, so the sort of come back, I think it's rallied 3 or 4 weeks off the low, pulled back 3 or 4 weeks here now. It hasn't gone to a new low. So McLaren's talk about sort of, price and time there, sort of normally if you sort of pull back, you go to the new high within the same amount of time or less. You have to hold the trend there. But in this case here, it hasn't gone to a new low in the same amount of time as the bounce there. So that's sort of, that is showing, possible change of character as well. We are seeing that some big lines of sort of stock getting through. So potential accumulation taking place there. So, yeah, I thought it was pretty interesting there, just sort of seeing some of those sort of stock lines as well. So, yeah, I think this looks pretty interesting. Just a sector which is sort of starting to get a little bit of legs as well. Yeah, this is sort of starting to look quite good.
Nice. Well, staying in the healthcare space, but going to the large cap hospital provider that's international exposure, Ramsay Healthcare.
Yeah.
Still, you've got that daily chart here and still showing that downward trend, that solid downward trend. But then you've got 0, 1, 2, 3. So are these just three marginally lower highs? Higher lows, I should say?
Yeah, so I think that, so that 2020 low, the COVID low, was $46.12. And that low here just recently went to $46.11. So we're 1 cent under the 2020 low. So sort of come back to a really big key level monthly as well. And we did expand to a slight new high, so we can go back to a slight new low there. But yeah, so since then we've sort of had, we've said, a little first bounce, second bounce, third bounce, so sort of starting to maybe showing a little bit of a basing characteristics here. So it's just interesting there. We've got a big level on a weekly and monthly chart, big retest there, possible false break on the monthly ranges. And now we're seeing on the short term, sort of a series of high lows. But it's still, it is a laggard, Chris. That's probably the negative, is that it is sort of, some of these other healthcare names are showing a lot more strength and ability earlier. So definitely have a bit more money in some of those other stronger names there. But it is sort of, it's just starting to see a bit of volume come in at each of those lows here now. So definitely seeing some signs of accumulation taking place. Does have a few basing sort of characters as well. So much prefer, rather than trying to buy these lows, let them find a low, let them see if they can base here, see if they can sort of get a 3 or 4 high lows before they go. I sort of made the mistake there with Resme. I knew sort of Resme was a good buy when it got washed out, but it took a long time to sort of build and get going. So hopefully trying to learn my lesson here and wait for a base to be built and then sort of come in after it's been built, So it's a little short here in time frame, but we still do have that sort of 3 high lows basically now. So it does look interesting, even though it is a bit of a laggard.
Okay. Well, going into the next one, we've got the British REH being the ticker here. Still those building materials that you were talking about more recently, but we've got this massive pullback and then slowly working their way up. Maybe a cup and handle in there, but it could be a massive cup and handle. Is that possibility?
Yeah, I mean, and it's tight too, Chris. It's actually that really, considering the sector's been under a lot of probably selling gear, like a lot of those stocks have been, you've had a pretty decent sort of sell-off there, and some of those building stocks there. This has held on pretty well. So really that's a sort of tight sort of setup there. So I was trying to think, it might have been Telix or something. There's one of those sort of stocks there, recently sort of had a bit of a cool off like this, and then just as soon as it broke out of the range there, went straight back to a new high there. So in the past there, I wouldn't have liked seeing that go to a new high above the previous 22 high. That's sort of that bit of a false break. That sort of always, but I know the stronger names, that doesn't matter. The strongest names, they sort of tended to, once they sort of come back in that corrective manner and break out, yeah. So this is, looking ominous there to me. Looks pretty firm here. So, yeah, it's definitely showing relative strength overall there. So I'm just trying to find a, low risk entry here, I guess. But yeah, that looks pretty ominous.
Nice. Well, the next one, Reliance Worldwide, still within that construction side, the plumbing, international exposure, significant revenues coming from overseas.
Yeah.
Similar sort of thing with that pullback, but this one looks a little bit steeper in what it's retraced. So you can see you've got the fib levels here, 0 being the most recent high, 100% being where it's come from in the low. So that's the 100% range. But then we've come back to this 50% point. So is that positive to see it come back to the 50% and bounce, or was it sort of bad to see it come back that far? How do you interpret that pullback?
Yeah, so good and bad. Yeah, you're right. So obviously we've seen here recently, like a lot of the majors sort of definitely pulling back into the ranges there, having sort of quite big moves up and down. And they are coming back to the, the big fib levels. So coming back to the 38 or the 50 or the 61.8. So they are bouncing up those sort of key fib levels, a lot of the majors here. So, but that has had a reasonable decline here. If you do that decline of that range, that's pretty sizable, but it is a level that I was looking at this thing, it's probably going to bounce from the 50, but you can't just go and buy that after a steeper climb like this. You probably want to sort of wait for sort of selling here. So the fact that it has bounced up here is a good sign here. So maybe this is just sort of one to keep an eye on here. Maybe we tighten up a little bit and then go, yeah. So now we're looking for maybe sort of something, we've had that sort of nice little bounce off the key level. Going to have to sort of build here now, maybe tighten up and maybe try and wait for sort of something a bit low risk then. But again, in that right area too, we're just sort of definitely seeing a lot of those property stocks have sort of come off quite a bit. I've seen James Hardie bounce as well. So it's just been all the property trusts have bounced. So it's a sector there where we're seeing a bit of strength come in here. So that's where I'll be looking currently.
Nice. Well, Reliance Worldwide, then we are looking at the biggest one on the market. Depending on how much BHP falls and CommBank rises, they're sort of changing pole position as to being the largest on the index. But you have talked about them being overextended and valuations. So can we just ask, while you're talking about the chart, may also give us a bit of context as to what you've looked at? You've traded the banks for a very long time and you've plotted the PE ratios of the earnings and how lofty it can get. So just when we're talking about extended valuations, can you just explain that one a little bit?
Yeah, I should have probably paid a quant guy about 10 years ago, Chris, to do the, look at the banks for the, I looked at the top 50 for about 20 years. And because a lot of those names are pretty similar, businesses don't change too much. And there is that as much as PEs are probably irrelevant for a lot of the growth companies, for the big sort of stable names, so that they can be, I think they're very relevant really for businesses that don't change too much, just to sort of where the market looks to sort of buy them there. So for pretty much for a decade there, you bought CBA between 13 and a half and 14 times there, you'd be probably buying, probably 85% of the lows. And then if you sold it around sort of, 17 to 17 and a half times, you'd be selling it at probably 85% of the highs as well. So for a decade, we pretty much trade within that range there. And within those periods, obviously you have the years where they may be slightly better, slightly worse, but even when they had the managed funds business where they're growing a bit faster, they still only would have got to around that 17.7 times was what the highest PE. So we're now trading at around 20, well, we were 22, I think we're close to 23, 24 times earnings here at the moment. And we've got no growth forecast for CBA. So they've gone back to a pretty vanilla, plain banking model, so maybe safer model, maybe less risk in there, but there's also less returns in there as well. So, so this is what happens. I mean, if you look at those sort of 70s markets there, we saw the value shares that had a pretty strong sort of time there as well, because people sort of, when inflation's high there, you got to get paid to hold assets and stuff there. So yield becomes pretty important there. So value shares, the ability to pay dividends does become more important in a high inflation environment. So pretty rare to get, normally like a 10% range would be pretty significant for banks, but what are we up around 30% here for CBA? So that's pretty incredible. So, but regardless of, markets there, if they run up quite strongly here, so regardless of my sort of fundamentals and yield stuff there, you got to follow price action. Price action is the key. And sometimes price action can go a lot further than you think, and it can pull back a lot further than you think. But what I do like here is that we have started to see a little bit of distribution, Chris, as well. So we're seeing some heavier sell days starting to come in. So a couple of down days there with some heavier volume. We've also seen a bit of a what I call like an exhaustive character. So a lot of stocks that have been running for a long period of time, they tend to sort of exhaust with a 3 month sort of rally there from key lows. So we've gone, I think it's around the 18th of April up into the April 17th, 18th of July there. So we've gone up sort of 90 days, 13 weeks, 3 months. That's how a lot of stocks exhaust into key highs as well. So we've also got that sort of secondary thing as well there. So, and if you look at some of the other banks as well, so Westpac's got a little triple, that broadening, 3 thrust high as well. So that's another classic topping pattern as well. So very similar to that pattern there, October 21. Westpac, it looks exactly like that right now. That little 1, 2, 3 thrust high in October 21 there. That's that. Look at Westpac look exactly like that. Same amount of time to the high. So some similar sort of timing as well. So we're all starting to show sort of a lot of those topping type of patterns as well. So we know they've been overvalued. Been overvalued for a while. They've gone far higher than anyone anticipated here. But we're starting to see some price action there now, some distribution, some exhaustion type of behaviour, just things that we normally see for eyes there. So I think there's some risk here. And I think they'll probably peel back a little bit here. CBA is going to report first week of August, so I don't know how it's going to substantiate a P of 24 or 22 or wherever it is back then. But I think it won't be able to substantiate where it is once it reports there, but in my opinion. So some risk there. And we're seeing in the last couple of years, actually, that because our earnings haven't been as strong in the last couple of years, that we've actually seen a few sell-offs sort of post-report there from the banks as well. So, yeah, just keep that in mind. There's some risk for me, but we do need to see the other sectors sort of stand up because that's the key for the market. So I think the banks will sort of meander back here. At some stage, you're going to see some selling here. Look, I might be wrong with the banks there, but I love what I'm seeing there technically. It's the first time I've seen some regional sort of sell signals find. But hopefully some of these other sectors can stand up here.
Well, for context, Iris is telling me the PE ratio is 22.94 with a 3.43% yield. Both of them quite extreme for the historical movements at CommBank. But you were talking about the other sectors, you were talking about possible rotation, you were talking about if we're to see this market remain higher or hold its ground with the banks coming off and possibly all four banks looking for a bit of rotation down, we do need to see a bit of lifting coming from the larger miners. BHP is coming down, trolling out near these lows, not looking too healthy. But just looking at your chart here, I'm going to take a stab in the dark and say maybe there's a marginal new high here, you're looking for a marginal new low, and that could possibly coincide with a reversal if they're to become back to be Australia's largest company on ASX from a market capitalisation perspective.
Yeah.
Is that worth a shot?
That's pretty much it, Chris. Yeah. I mean, I guess the only negative there is that normally when you sort of break the low to a new low, that's quite negative when you've sort of broken key support. But yeah, not sort of seeing super volumes coming through there. There's a little bit of discussion about BHP's dividend being slightly less moving forward there. That's probably the one negative in the marketplace there. But just in this type of market here, we've been a very range-bound market there for the last few years, and like a lot of stocks sort of going up and down these big ranges there, back and forth. So marginal new highs, marginal new lows there. So yeah, so to me, I've got a position here. I'm just watching this pretty closely, but I think I think there's a high probability we'll break to a new low, which we've done now, but then you want to basically break back above the previous swing low as well before, so we're just looking for a false break there. So, we can't just buy it here. We've got to basically wait for some sort of confirmation there for that as well, because it is sort of at this stage still sort of trending down as broken down. So that's a bit negative. But I think if we see a false break here, some sort of positive reversal, it's showing here that you follow those, previously there. So definitely one to watch pretty closely, into the end of this week.
But yeah, definitely to understand what we're sitting with in the context of the overarching economic factors pushing into market and the best trades. Your analysis has shown that inflationary periods, you do what is it? The higher yields, the value shares, the energy producers. What were the other standouts from your research that's helped you focus into this current period?
Yeah, obviously sort of energy, precious metals were sort of key areas and stuff there, but generally commodities are pretty buoyant throughout the whole period there. And at the moment you're seeing BHP, Rio, Fortescue, Mineral Resources, some of those bigger ways, they're all pretty deep here. I think Rio's had a big ABC, clear near low here. Mineral Resources has sort of had a really deep low, bit of a bounce and a little bit of an ABC back there. So it's showing potential here. So a lot of these stocks are potentially at key levels there where they could turn here. So, but haven't seen them turn yet. So, just a really interesting sort of where we are here. So, so I just think those dynamics there, like, the banks are just starting to show some signs of distributions of selling take place, and resources are on their knees. Like, everyone's getting a bit worried about them. That's sort of getting a bit negative. So that's what you normally would see. So, but if they do reverse here, that would probably be a good sign for the overall market there. Yeah.
Well, those who want to do more research, click on the right. We'll see the 40s and 70s research that Gary's previously shared with us. And to that end, thank you very much, Gary Glover from Novus Capital.
Thanks, Chris.